Hello, everybody. I'm Simon. Glad to participate in CTAC conference. My session is about proof of reserves and real-time reserves in practice. Our agenda and our scope, I'm going to talk a little bit about myself and the firm where I work today. And then I will cover a little bit what I call the accounting duality of blockchain. So it's a little bit a theoretical, technical description of what blockchain does well and what it doesn't do so well, and the ramifications that it has on the various different applications that exist in the ecosystem. And then we'll dive into some details about proof of reserves and real-time reserves. So I work with AlgoMetric.net. We are a technology firm. Our specialty is custom software development and outsourcing. We are not an accounting services firm, but we do work with accounting services firms. We also have our own product built for CPAs, accountants, and auditors called Protocol Scout. It's coming on market in the next couple of weeks. And it is a multi-chain explorer, which is custom built for accountants and CPAs. I'm Simon. I am the digital assets product lead at AlgoMetric. My prior experience in blockchain was at Armanino, where I was the tech lead for the digital assets practice. While there, I worked with various customers like Kraken and Nexo, Archblocks, and so forth. I also spent some time working at QuickNode, which is a blockchain infrastructure firm, at a GMO Trust company, which was is and was stablecoin issuer, as well as Omega One, which was crypto exchange dark pool. So I've kind of covered several dimensions of the blockchain and digital assets activities. So the accounting duality of blockchain. My simple explanation is that accounting on blockchain is both simple and difficult. One way to describe blockchain is a network of nodes, servers, which maintain a ledger of all transactions. Amongst themselves, these nodes, they speak to each other. They're sending messages to each other all the time. And independently and on their own, they are agreeing on what should be in these blocks that make up the blockchain. Nodes also listen to the users. The users give commands to these nodes, such as transfer something from A to B, or hey nodes, please tell me what is the current status of some asset X in some account A. The language that these nodes use is something called RPC. In simplified terms, it's really kind of like text messages that are being sent back and forth between both the users and the nodes. Users talking to the nodes, nodes talking to users, nodes talking to other nodes. These users actually are various different applications that humans use. So a MetaMask wallet, Exodus wallet, trading bots, different analytics apps, explorers to the blockchain, they are the blockchain users. Now the nodes themselves, they have to have somebody operate them, paying for electricity and hosting and disk space and whatnot. So there's kind of like two broad categories of nodes based on how they're operated. The users themselves can operate the nodes. In that case, you have to pay the server cost yourself, or you can let one of the infrastructure companies operate the nodes and you use their node as a service. So companies like Alchemy, Infura, QuickNode, and so forth. Now the blockchain itself, another way of describing it is that it's a ledger of all the transactions that took place amongst all the participants in a blockchain network. What that means is that it is not a list of the transactions that I need for myself. It is a list of all the transactions. The ones that I need, they're buried amongst all the transactions. So if I'm looking at just the basic setup of the blockchain, in order for me to just process the transactions that I care about, I would have to first read them all. And then, that's millions and millions of transactions. And then I would actually have to filter out those that interest me. Now, wouldn't it be simpler if there was a sublist of these transactions for each ID? Yes, that would be simpler, but that would require more disk space for every single node. And nodes are already duplicating a lot of the data, all of the data, all of the basic data, which is how they are able to establish decentralization of authority. Since nodes duplicate basic data, they can repeat things and validate things without having to depend on another higher authority. But because they're spending so much disk space for the basic data, they don't really have disk space for auxiliary data, such as these sublists of transactions that may be important to me or you or someone else. And that is why we have a whole ecosystem of apps that exist around the blockchain in order to make the blockchain more user-friendly to individual accounting. One of the famous apps participating in this conference is Bitwave. If you were to look at simply like the mathematics, the Ethereum mainnet today requires about 4 to 15 terabytes of data, and that's without all these sublists. So if the sublists required additional 10%, multiplied by 10,000 nodes, maybe there's even more nodes than that, $100 a month, we're talking, millions of dollars a month of extra disk space and extra expenses to the node operators if the nodes maintained these sublists. Another element that makes accounting on the blockchain more difficult than it would be obvious is the concept of private key, public key, and public address generation. So users pick, use an app to pick a private key. There's some processing and formatting to generate a public key. There's some more processing and formatting to create a public address. And that's what happens for every single blockchain. So what that means is that because every single blockchain uses the same process, any ID that exists on any one of the sibling blockchains, the blockchains that use the same process, can actually exist on all of them. And you don't know whether it exists on all of them or not until you ask. There's not a master blockchain of all blockchains to tell you what are the places where an address exists. So if you look at just the Ethereum ecosystem, any address, any account that exists on Ethereum can also separately exist on Polygon, Optimism, Base, Polygon ZK EVM, Arbitrum 1, Arbitrum Nova, Metis, ZK, and so forth. And the amounts of assets that exist, that might exist, would actually be completely separate amounts. So if you have a customer that says, oh, here's my address, go look it up over there on the blockchain. If you don't have any more information, you have a lot of blockchains to look. And there's like various different levels in the ecosystem. There's the L1, L2 relationships. There's the EVM, so-called EVM compatible chains like Phantom, Celo, Gnosis, Avalanche, Fuse, Harmony, Tron. And so in order to account fully for any one ID, you really need to account on every single blockchain that uses the same type of format. If your responsibility is to account all possible assets for a given unique address. As far as I know, there's like 350 there's 350 protocols at least that have some kind of significance. And so now we're talking about massive amounts of nodes, massive amounts of messaging back and forth. Hey, here's an ID, give me a balance, and so forth. So you need to query many different nodes. And to make it even more complicated, assets can be bridged from one protocol to another, but there is no one place with a master list of all the bridges and all the siblings, because nobody controls it. So nobody enforces what bridges and what assets can exist and cannot exist. Therefore, there's not an auxiliary list of all the bridges and all the assets. Another dimension, not native assets, the so-called coins, they are hard-coded in the blockchain protocol. So BTC is the native asset on Bitcoin, Ether is the native asset on Ethereum, and it's hard-coded. But ever since we've had the second, third, fourth generation of protocols which are smart, they provide the ability to users to create their own assets on a protocol. You deploying the so-called smart contracts. And so one big example that everybody has heard of is USDC, USD coin, which is not a native asset. It was created by a separate entity that doesn't really doesn't maintain Ethereum. So they're smart insofar you can create smart tokens and smart contracts, but they're not quite as smart when it comes to accounting, because a blockchain, using their own native language of RPC, the blockchain is not even able to tell us a definite list of assets that exist on that blockchain. There's no such a way of speaking to the blockchain. As a matter of fact, you can't even ask the blockchain to tell you all the assets that exist in an account. So instead, what happens in the background, behind the scenes, we are actually asking the blockchain, hey, blockchain, does account A have asset 1? Okay, does it have asset 2? Does it have asset 3? Does it have asset 4? And so forth. So all the different tools that we use maintain separate external lists of possible assets, and then they use those lists to query these blockchains individually to collect all the data from the blockchain. And it all goes back from that need to minimize the quantity of data, because we are already maximizing all the data because we're duplicating it because we need it in order to have decentralization. And then as far as the blocks, blocks are batches of transactions which are added to the top of the blockchain. And the frequency of these blocks varies from protocol to protocol. So some protocols may have new blocks every 10 minutes. That's Bitcoin. Another popular Ethereum has about every 13 seconds. Other protocols add new blocks every 3 seconds, every half a second. The blocks are just stacking, coming in on top. And each of these blocks has a UTC timestamp. So UTC is the universal time, and every subsequent block has a timestamp which is greater than the previous timestamp. But the RPC blockchain language does not support access by timestamp. So what we really have to do, we need to figure out the corresponding block ID of the point in time where we live and where we do things in order to be able to retrieve that data. So perhaps you live in Los Angeles and you are doing some kind of an audit processing based on a 9 a.m. some point in time in Los Angeles. That audit may yield different results than an accountant or a CPA doing audit in Tokyo for the same point in time in Tokyo, because Tokyo and Los Angeles are 17 hours apart, which on the blockchain is about 4,700 blocks difference, perhaps, if we're talking about Ethereum. So one big important auxiliary tool in all this blockchain business is being able to traverse the blockchain in human time, but actually translate that into blockchain's way of thinking about the passage of time, which is really in blocks and timestamps. So now all these different things kind of have their own impact on how you end up doing a thing called proof of reserves. So conceptually speaking, a proof of reserves, it's usually about an exchange, a crypto exchange. So imaginary Kraken base, a crypto exchange, might not be regulated and therefore might not be obligated to provide full audits for other reasons. Perhaps they're not yet listed on New York Stock Exchange or not listed on NASDAQ, and therefore they're not obligated to have a big top five auditing firm and do regular quarterly, yearly audits or things like that. Okay, but still, they wish to demonstrate to the public that their liabilities are less than or equals to the assets that they have. Now, in their case, in the case of a crypto exchange, their liabilities are what their users think their users have in their accounts, and those accounts are in a database. They are in the trading platform of that crypto exchange. Meanwhile, the assets are on-chain. They are in coins and tokens in the wallets of that crypto exchange on various different blockchains, of which there are many, and various different assets, of which there could be also thousands. The goal of this crypto exchange is to show a lot of information to the public, but not show quite everything. One thing they may want to do is maybe they don't actually want the public to know the exact number of users that they have for whatever reason. So it is not desired by them to simply create a big report and spit out all the anonymous data about every single user for everybody to look at all that anonymous data. So what they might do is they might pursue a proof of reserves in assisted by a third-party auditor. And there are two basic ways of doing proof of reserves: assisted by a third-party auditor, or utilize a two-party system, which is really directly between the crypto exchange and its users. I've spent more time working with the third-party auditor assisted proof of reserves, so I'll speak more about that. Another consideration in this work is, okay, a crypto exchange might have hundreds of different assets, and they're not all equally important. Maybe 90% of the value is in Bitcoin, and these other 100 assets are just much smaller percentage, but the work to do the processing of all that is equal. So a crypto exchange may pick a subset of assets to do the proof of reserves over. Okay, and things move quickly. The records are changing in the database all the time. Assets are changing on the blockchain all the time, deposits, withdrawals, and things like that. So proof of reserves is pretty much done periodically at a point in time, perhaps quarterly or every 6 months or so, because it's quite a bit of data processing, data collection, and comparison, and things like that. That it takes days to do it really well. So the way it plays out. Okay. Let me just see. Just a second. Okay. Okay. So the way it plays out is, we said assets and liabilities. Proving assets can be considered to be somewhat simpler side of the equation. So what happens is the crypto exchange will create a list of the addresses that they have on the chain. The auditor will give them a challenge instructions, something like, okay, please create the following transactions in the next 10 minutes, because if you can create these transactions, then we can believe you that you have the private keys that belong to these addresses, and that you're not simply telling us some random addresses that belong to some other whales or something like that. Then the exchange indeed does answer the challenge by signing these transactions to prove the control of the private keys for the provided addresses. Auditor then proceeds to the next step, which is to use the historical data to sum the on-chain balances at the point in time which corresponds to liabilities snapshot. So perhaps the liability snapshot was from November 30th, midnight UTC. And the auditor then may also look at other transactions which may have happened sometime before or after that point in time, just to see if there's some suspicious transfers. One thing we don't want is the crypto exchange to borrow some Bitcoin temporarily just to increase the quantity of assets in their addresses during, while the auditor is watching, and then turns out that they don't actually have all the assets. So the auditor then needs to look for those as well to see if there's been some, strange activities over time. So that's the assets side of the computation. On the liabilities side, things can get a little bit more complicated because it's not necessarily a full financial audit. So depending on terms of service, those need to be examined. Different exchanges have different terms of service. They may have company liabilities. They may have borrowed some Bitcoin from one of the co-founders a long time ago and have it in their addresses and appear that they have it in their treasury for the users, but actually it's owned by another entity that may have seniority in case of some kind of adverse event. The data about the liabilities is in a database, in a private database, and no crypto exchange would allow somebody else to read data out of their database like blockchains allow people to read data off the blockchains. So there's a little bit of a trust question of how does the auditor really know that the crypto exchange has provided a full list of all user accounts that have some liabilities involved and that have rights against those assets on the blockchain. Another complication is exchanges can have both spot trading as well as derivatives. So how do you properly account for the futures or options positions and things like that users may have at the time of the audit? There's this whole staking thing. Many exchanges are allowing people to indirectly earn staking income by still running in the database and things like that. And exchanges can have their own accounts. And you could ask yourself, well, are these accounts equal in terms of behavior, in terms of their impact on liabilities and on assets as those others accounts, regular user accounts, or not? One famous exchange that had some very strange accounts was FTX. They had those accounts for Alameda, which had infinite leverage and infinite margin. How would the accounts like that be accounted for? So the auditor doesn't actually get direct access to the database and has to trust the exchange that the exchange included all the appropriate user records in order for the auditor to sum up correctly and fully all the liabilities which need to be compared against the assets that were on chain. So in practice, the way it plays out is there's a little bit of a three-way standoff between the exchange, the auditor, and the users. Each of them has two pieces of information that they use in order to kind of trust each other in this triangle. So an exchange has to anonymize all the user data that they give to the auditor. They're not allowed to give actual names of actual users to the auditor. So auditor can't technically call up any of these people and say, hey, how many Bitcoin do you think you have on this exchange? Because over here I have a 5 for you. Do you think you have 5? And then the user says, oh yeah, thanks for calling. Yes, I think I have 5. Okay, then so the auditor cannot do that. Auditor has anonymized information. So what they end up doing is the auditor creates a separate application that users can use using their anonymous information and their anonymous IDs to check that they are included in the list of users which were received by the auditor. And the idea is that if some user uses that app to check their own participation and they're not in it, then they would be screaming about it. And that's how the auditor would learn that the exchange didn't hand out over all the liability records. Okay, and then the exchange is also responsible to give to their users the anonymous identifiers that their users can use to go and check this database, this online app, if they wish to do so. Of course, you cannot force the users to go and check that they were included in this process. So by having this independent application where users can check that they were included in this liability computation, there's a standoff between the three groups, and all three of them are then motivated to participate in this, and then therefore they can trust each other. Okay, and that's basically the high-level description of how a proof of reserves works in a topology which involves a third-party auditor. The alternative to using an auditor is to do it directly just between the exchange and their users. In a setup like that, it might cost less for the exchange because they don't have to pay an auditor for the auditor services. But exchange must disclose more data to the public. Exchange must tell the public, these are all our addresses on chain, and here's proofs that we own them because we did this and this and this and on and on and on. And they also must create a so-called Merkle tree, which is a kind of an esoteric thing, but essentially it is used to prove that multiple pieces of information are part of the same data structure, that multiple users are all included in one big liabilities file, which contains anonymous IDs that only individual users know themselves. So in this two-party system, users then have to perform more work themselves because users cannot rely on a third party to have gone through all the addresses, to have added up all the historical balances, to compare the total liabilities and the total assets. Users must perform that work themselves in an Excel spreadsheet or whatever. So one of the ways of thinking about all this is that the third-party involvement reduces the effort for the users. Reduction in this effort increases the chance that the users will participate, okay? And therefore, that three-party setup is superior to the two-party setup because it increases the participation of the end users and their confirmation that indeed all of the users were included in the liabilities computation.
Simon, real
And that's
quick, I do have
yes.
a question. I'm just learning all of this now. How often are these audits being done? Is this like a continuous thing, like timing wise? How often?
So there's very little regulatory obligation for that at this time. So the crypto exchanges, perhaps Coinbase, they do theirs as part of the regular financial audits that they do as part of the obligation to the Nasdaq and New York Stock Exchange.
Gotcha.
But
Okay.
if a crypto exchange is not listed on a stock exchange, then they don't have that obligation. And then the only question is, why would they do it? Well, then it's kind of like the public reputation pressure, and it's up to them to decide how frequently they want to do something like that with whichever firm they hire to do this sort of a thing for them. So
Gotcha. Thank you.
one famous crypto exchange, not Coinbase, has been doing it about every 6 months. Okay. All right. And so that's kind of like the high level proof of reserves. A similar thing, but kind of inverted, is called real-time reserves. A same auditor entity may be providing services for proof of reserves to crypto exchanges, but also real-time reserves to stablecoin issuers. So by the way, in one company participating in this concept of real-time reserves is called Chainlink. In Chainlink's lingo, they are using words proof of reserves for what is real-time reserves. But so what Chainlink calls proof of reserves is not what you would do with Kraken. Okay, it's a different thing. Generally, real-time reserves is about stablecoins. So we can imagine, stablecoin USDX may not be regulated and may not be obligated to provide the full audits for other reasons. So motivation is quite similar to the motivation to doing proof of reserves. But what's opposite is that the liabilities and assets are in different locations. So whereas proof of reserves, the liabilities were in the database and off-chain, in real-time reserves and stablecoins, the liabilities are the tokens which are on-chain. And the assets of the real-time reserves stablecoins, they are off-chain because they are the ones that sit in the bank's database. So they take fiat into a bank. Once they receive a fiat into a bank, they receive message from the bank that such and such entity has deposited $1 million. Okay, then they go in and they mint 1 million tokens and they send them to that user's wallet. Or the opposite, when a user sends them 1 million tokens, they burn the 1 million tokens and tell the bank to do a fiat transfer from the bank account to the user's account. Also, again, goal is to show a lot, but not necessarily everything. So one example is the issuer may really want to convince that, hey, we have 1 million tokens and we have million or whatever is the backing asset of it, but maybe it's a combination of some dollars, some treasuries, some liquid, other highly liquid assets, and they don't necessarily want to, expose all the exact account numbers and QSIPs and ISINs and all that other stuff. So what they do is they hire a third party to help them in this process by providing the trust relationship with the public. And what the real time means in this case is that it is a higher frequency than what a manual review can do. So a real time means it's being done every couple minutes or even 30 seconds or so, whereas without it, there may still be doing some audits and attestations with an accounting firm, but perhaps those are happening monthly. So if you go on a website for Circle's stablecoin USDC, you can see that there is an attestation happening every month. So it's not real time, but it's certainly happening. And then if you go with another token that is doing it real time, you'll see that they're doing it every 30 seconds or so. And then the output of this real-time reserves processing, it can be either fed to some website where you can go and download a PDF report that says, we are an accounting firm, and 30 seconds ago, we have compared their liabilities and their assets in the bank and on the on-chain, and we attest that their tokens are covered with assets. But also they can be fed, this information can be fed directly on-chain in a way where the issuer can't even mint new tokens until there's a message that says that new fiat has been deposited into the appropriate bank account. So I'm going to cover that in a little bit more detail with some high-level steps in an overall sequence. So a fiat-backed stablecoin, first step in the life of it is stablecoin issuer creates some smart contracts, because we mentioned that smart contracts are the way you create assets on the blockchain. They may do this on one or more blockchains. So now if they chose to do this on multiple blockchains, you need to be doing processing from multiple blockchain sources. Then the issuer hires a custodian. Generally, that's usually a bank, but they can hire multiple banks. Maybe they have one bank in every major region, one in Asia, one in North America, another one in Europe, just because people are sending money from multiple places and they want to receive redemptions into multiple regions. They also hire an auditor, a CPA firm, and they instruct the custodian to share the custody information directly with the auditor. So the key here is that the custodian does have the capability to do that in real time, so that the custodian, that their bank accounting system has an API system which can safely transmit account balance information to third parties based on authentication, passwords, user IDs, things like that, over the internet, computer to computer. Because in order to do this real time, it's all the computers doing the processing, not humans looking at screenshots anymore. And then the auditor does either integration themselves, or they can outsource that to another firm like AlgoMetric, which then builds an application. This application does data collecting. It's constantly running. It's collecting data from the bank API. It's collecting data from the blockchain nodes. The application then does the comparing, that the liabilities are less than or equal to the assets. This app can also dynamically create the PDF file that is made available to anyone, public. This information can also be delivered to a website or multiple websites, and there also has to be a process to manage exceptions. What happens if the bank API for some reason is stopped because the bank is doing maintenance? What happens if Solana blockchain has temporarily stopped for 3 hours because there's been an upgrade, downgrade, or something like that? So this application that is doing real-time reserves has to be able to decide, is this an extraordinary situation because of some systems issues, or is it extraordinary situation because somebody stole the money from that bank account and there's no more money to back that token? Which is it? And so it runs all the time, every couple minutes, or even more frequently, and it's constantly watching over the liabilities and the assets. And that was kind of like the original early version of the real-time reserves. Recently, in the last year or so, another couple steps have been added, the optional steps, where the auditor delivers the data, the results of their observations via a public API that anybody can access. So it could be something like auditor.com/stablecoin/liabilities and assets. Anybody can check that data. And then both auditors and other people use that data and feed it into a Chainlink installation called oracles to make that data available, the plus minus, to make it available on chain. And the issuer prepared for all this by creating the smart contract in such a way that the smart contract doesn't allow minting or creation of the new tokens unless the liabilities plus the mint amount is less than assets that are coming from the bank data feed through this API feed through the oracles. So that way, the smart contract itself doesn't want to create new tokens unless the bank has reported that now there's more money in the bank than there was before. And so that's the newest addition to this whole real-time reserves processing, and the company that leads in this space is Chainlink. And that's pretty much majority of what I prepared to discuss. Hopefully some questions or some comments. Let me see if yes, I'm at the end, right? So. Yep, that's it. Yep.
Great. Yeah, I think that was a very informative thing. I would love to get the presentation if possible, and then I can share it with everyone in the group as well. I'll upload that just
yes.
so we could use it as a reference. And then, so I'd like to ask you, I don't know how much you can talk on it. You know, I may know a little more than I should, but what are you guys doing to kind of simplify this process and, you know, try to make this more accessible specifically to CPAs and tax professionals working in the space?
Yeah, so the thing that we have decided to address are all those different elements in the duality of accounting on the blockchain that we have described. So we are building a blockchain explorers for CPAs, which is aware of all. It's impossible to be aware of all the different blockchains. There could have been a blockchain launched while we were talking, and we wouldn't know about it until we hear about it from some ETF launch, theoretically speaking. But basically, that knows about all the major blockchains that exist in the same ecosystem, so that you can just provide an address once, and the blockchain explorer will look for that address on 10, 15, 20, 50 blockchains in parallel and report back to you everything that it finds. So it becomes a little bit of a scout. That's why we're calling it protocol scout. It scouts protocols for you. In addition to that, it also knows about the assets that exist on different blockchains, because we've scouted those beforehand, so that it collects data from multiple blockchains for multiple assets, and it kind of merges all that stuff together into a way that is easily exportable into a spreadsheet, but is also easily verifiable, because every piece of information that it collects, it also allows you to check that same piece of information on a second source, which would be a corresponding third-party independent blockchain explorer for that additional specific protocol. And then to wrap it all up even more nicely, we are creating a way of being able to browse all this information by date, hour, and time zone. So if you wish to browse balances for an address as of January 1st, 10 a.m. Los Angeles time, you can just specify that, and it will retrieve that point in time worth of data without you having to look for the different block numbers that correspond to that point in time on every different blockchain. Because since blockchains live independently of each other, since their block frequencies are unique to them, 10 a.m. Los Angeles time on one blockchain is block 1000, on another blockchain is block number 351. But because we are creating the ability to browse blockchains by date, time, and hour, as well as time zone, we are basically extrapolating all that information away from your responsibility and making it all nicer and faster to look for both balances as well as the token supplies. So it becomes like a uniform interface to access this information without going through all the different things that perhaps as an accountant you don't need. As an accountant, you're probably more interested in the valuations of things across the board and not necessarily interested in the smart contract code, because some of the more classic blockchain explorers that exist, they are specialized for developers. They let developers look at individual transactions and different opcodes and different different bytecode and all sorts of smart contracts and all sorts of things like that, which is important to developers, but accountants perhaps care more about a broader strokes across the multiple blockchains and not necessarily vertical slicing into individual blockchains. And the application is called Protocol Scout. We are in the final phases of being able to release it for about 15 blockchains. So in our next release, you'll be able to type in an address once and get information from 15 blockchains and about 2,000 assets in just one click.
Love it, love it. I would imagine that this would come in handy for when you're working with clients, maybe those clients that are not as skilled as some and maybe don't, or just messy in their record keeping and don't have access to different wallets and situations like that. Maybe tell
if I had a nickel for every time that a client gave me incomplete data or forgot to tell me about a wallet on a specific chain, or I know that different tax practitioners as well, they implement testing procedures for when they're hiring new staff, and they will slip in transactions from other chains and not necessarily tell them because they expect people to be looking on different chains. So I think that this could be a really awesome tool for just practitioners who want to, have a tool in their toolkit that allows them to identify any potential other chains where there's activity, so you don't miss that stuff. Really, really important for completeness, I think.
Yeah, and users may have bridged something from one to another just to play out with it weeks ago, months ago, and then might have not done much with it. And now it's like, oh, wait a second, was there maybe, was it ZK Sync or was it Polygon ZK EVM? Which one was it?
Yeah.
Maybe for, but actually they work the same way. They have the same address, Ethereum. Ether is the native token on both. You could have bridged one or the other. Who knows, right? And then of course, accounting applications do a lot of this stuff in the background themselves, but in order to first use them, you have to create accounts with them, you have to load the addresses, you have to do a lot of the configuration before you may even have a relationship with the customer. So this Protocol Scout app becomes kind of like a simple, fast way of taking a broad X-ray of activity for your future customer, and then you may get a better assessment before you go through the process of doing full-on accounting for them using one of the specialized accounting applications.
I love it. I would assume also this would be able to discover all digital asset classes, NFTs, stablecoins, things like that.
Yeah, so in our next iteration, we are focusing on the most popular group on every protocol. So primarily the token style things, but indeed there is a lot of repetition of the way the NFTs work across different blockchains, and so that would be like the next dimension of expansion. Correct. Yes.
Great. I love it. We can turn to the chat. If there's any more questions, feel free to turn on your mics or cameras. Simon is with us to answer any questions, or you could ask them in the Q&A or the chat section, and I can read them out loud. Simon, any final remarks? Anything you'd like to touch on? Anything that you think may be important for the session?
Not really any more so than it's absolutely not difficult. It's not impossible to do accounting on the blockchain. There's, people have been building tools for that purpose, but there's definitely some intricacies, and it's not entirely all plug and play. When a new protocol launches, it can become popular, very quickly before the tools catch up. And so there may be some lag time in terms of how quickly all the different tooling may come online. Every single accounting application, of which there's many, they have to go through a similar process of integrating that blockchain into their processing, and for whatever reason they may not be doing it all at the same time, or so that is always a factor to be considered.
Makes sense, sure. How can people reach out to you and find you online if they had more questions about Protocol Scout or anything else that you discussed today?
Either protocolscout.com. There's a contact us link which leads directly to my LinkedIn. I prefer contact through LinkedIn, and then hopefully soon we can continue working with you guys.
Yes.
Through future conferences, as well as the tools that we would like to make available to your audience and your subscribers. We would like to have those tools available at at their convenience and to their heart's content, to run these queries and get these balances and transactions and all sorts of things directly within your application, directly within your website.